Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. We begin today with TikTok. The company has signed a deal to sell its U.S. business to three American investors, Oracle, Silver Lake, and MGX. We've also learned that U.S. user data will be stored locally in a system run by Oracle, and TikTok's algorithm will be retrained on U.S. user data to ensure the content feed is free from outside manipulation. Here is Bloomberg's Mike Shepard.
The idea is that it would be a copy leased from ByteDance, but then retrained to some degree or another by Oracle and also walled off in a way. They would create some sort of a security firewall or barrier that would keep ByteDance from ever gaining access to U.S. data or to the algorithm itself out of concerns that there could be some manipulation.
That is Bloomberg's Mike Shepard. On Thursday in the U.S., the CPI report showed retail inflation cooled at a startling clip last month. The so-called core rate of CPI increased at an annual rate of 2.6% in November. That is the slowest pace since 2021. But there's a caveat. Because of the government shutdown, the BLS could not collect prices throughout October, and price sampling in November started later than usual. And for that reason, Fed policymakers may be a little skeptical on the accuracy of the CPI data. Markets, however, were undeterred. We had a rally in both U.S. stocks and bonds. And we got some reaction from Amy Xie Patrick, head of income strategies at Pendal Group. She spoke with Bloomberg TV host Paul Allen and Annabelle Droulers.
We've got that 2-year yield now in the US at a 3-month low, and even though that CPI data was shutdown impacted, it does suggest more easing's coming. I guess the question is when? What's your timeline?
Does it, though? I would question, because I looked at the yield curve moves last night as well. And the reason the yield curve is important is because generally when the market believes that the Fed or any central bank is in an easing cycle that has a lot more room to run, then the curve is happy to steepen. But now when I look at the reaction in the US curve relative to the downside surprise of last night, notwithstanding some of the caveats around the data, I kind of think the market already got there. The market already got there in terms of for the way that US inflation is turning out right now, and all the other data points that we've had, around unemployment and things like that. We've got 2+ cuts baked in for the Fed for next year, and the market didn't really want to do more than that last night. So I question with the way that things currently are shaping up in the US, whether more easings will be necessary from the Fed next year.
Well, that's an interesting point that you make, because it was certainly a theme of 2025, the market really getting ahead of itself in terms of what it was expecting, and then the Fed not following through. Do you see this happening again?
Possibly, right? So I would say that the 2+ cuts that we have in the front of the curve is broadly matching what the economic fundamentals should suggest. So you've got inflation still coming down, but still a little bit stubborn. The Fed's inflation target is 2%. And so where we are right now is not 2%, obviously. Unemployment, yes, it's the labor market's loosening, but there is no unemployment crisis that would suggest recession is around the corner. So why would we have more than 2 cuts priced in? Well, I think it's a little bit of what my colleagues and I describe as the Trump tail trade, right? To the extent that he hires somebody into the Fed chair role that is a bit of a yes man and threatens Fed independence, got to put some premium into that. So there's a bit of that. And then to the extent that Trump also manages to engage in large-scale tax cuts that would be, not all that beneficial to the back end as well, but has an anchor at the front because he's hired a yes man, then maybe that keeps the front end down as well. So I feel like that's the way the market's pricing in that sort of Trump tail risk at the front end of the curve. It's not entirely economic at this stage.
What about what we're getting from other central banks? Because one of the other key themes we've been talking about is central bank desynchronization that could have been anticipated for next year. I mean, we had the BOE, for instance, the ECB, both maybe saying overnight we're done on the easing front. Do you see then, in light of your views around the Fed, and it may be not much as easing as could have been anticipated, are we going to be a little bit more synchronized perhaps then for 2026?
So short answer is I do think we're going to be more synchronized, because there is nothing to suggest that the world is all that desynchronized right now. There are certain pockets of stories. Europe will have more fiscal stimulus next year. China, question mark about which way their stimulus is going to go. But overall, I do think there will be more synchronization than what is currently priced into markets. And for me, the biggest standout, and we haven't touched on it yet, is the pricing for the RBA here in Australia. Right? So we are a central bank where the market thinks that next year 2 hikes is actually appropriate rather than any further cuts. And again, I look around at our economy, and yes, we're this country that's further away, and we've got our own immigration dynamics, but there's nothing fundamentally all that different economically about Australia that would mean that inflation is somehow getting out of control here and only here.
Yeah, because yesterday, for instance, we were talking about just that. The split that we're seeing from the big 4 banks essentially on whether even February is appropriate for the first hike. So are you sort of very much staying away from that then?
Look, I don't feel strong enough to put a trade on for February at this stage. But I would argue that, the RBA is definitely waiting for the trim mean data. I would argue that there's even further room to look, to wait a little bit longer. Because some of the blips that we've been seeing coming through our inflation data, when I think about it, it's to do with the timing of subsidies coming off. But when I think about the trends in wages that you see in Australia, and the reason as a central banker you'd really worry about inflation getting out of control again in your country is if you see signs of any spiral happening, right? Whether it's expectations into actual inflation, whether it's wage pressures into actual inflation, none of these things are happening in Australia. So if you even do get a, let's say, 1% trim mean quarter on quarter, there might still be room to wait beyond that. If I had to put a trade on, I would probably still lean against not February for the first hike, if indeed any hikes next year.
Growth in Australia is pretty anemic, though. I mean, it's not part of the RBA's mandate, and it's mostly being propped up by government spending at the moment. Would that be a factor, considering inflation, as you say, isn't out of control?
Yeah, so you're absolutely right. Growth it's anemic, but there are signs that the consumer is starting to spend a little bit more. The huge problem in Australia seems to be productivity, right? And I think the public spending and the productivity, they're hugely related, because the public spending in Australia has led to more of the employment growth in Australia being in sectors that are productivity constrained by nature. So, more healthcare workers because of NDIS, things like that. And as a result, we're not seeing proper investment in Australia into areas that can actually be far more productive. Now, on the other side of the pond in the US, they have been more productive, but is that productivity story being now offset by the fact that Trump's immigration policy is causing, the cheap and perhaps undocumented labor that was propping up those productivity numbers in the US to now shrink and reflect the real productivity underlying in the US as well.
What about the speaking of the currency? I mean, one currency pair we've been watching is the Japanese yen versus the yuan as well. And what are you thinking about the Chinese economy and as well what the yuan's signaling, but also the outlook for stimulus?
The Chinese economy has been really interesting this year, and especially when you put it against, for example, how the MSCI China index has been doing this year. So this year's been another year of a lot of hope about what Beijing will do for the Chinese economy in the wake of the property bubble bursting. And yet, a lot of talk, not a lot of stimulus. Yet the equity market has actually done pretty well in China this year. So I think it's a tale of two halves. The equity market is probably a reflection of this is what happens to markets when expectations are so dire, when so many people have given up on a growth story. You don't need a lot of stability. You don't even need growth for the equity market to be able to perform. But on the actual policy side of things, I mean, I've wanted again and again to have a trade on where you bet that yields will rise in China. But I still think it's too soon for that trade. Every time we've had some momentum in Chinese government bond yields selling off, some policy disappointment comes through. I think that ultimately for Beijing, what they need to come to sort of grips with is how much of a fiscal lever they're willing to pull without it affecting the property market, which obviously they don't want to again, such that they can convince Chinese consumers, who are the real weapon here in terms of the next part of the Chinese growth story, to take over that mantle from public to private and move forward. Beijing's nowhere near comfortable in engaging in that sort of helicopter money stimulus, in my view.
Okay, so if you're not quite having enough conviction around Chinese and also around Australia, just mentioning there with the RBA, what is your strongest conviction call for next year then?
I'm actually a little bit worried for next year, and I'm not sure what is going to be the best way to express it. So normally whenever you guys have asked me that question, and I've not had strong views on equities, I've not had strong views on China, I've not had strong views on bonds, I've kind of gone, investment grade credit is where you should park your money, because a bit of floating rate credit, nice accrual, you roll it down the curve, that's a great way to just sleep at night and make money. Now, I feel like that story could have a couple of wobbles in 2026. Main reasons being not that defaults are going up wildly, but what is going to happen with the valuations baked into AI, or the hope of the AI capex that is happening right now, what is funding that AI capex, and then all the worries behind private credit as well. So this idea that there are potentially two bubbles, I don't know if they're really bubbles, to be honest, but if there are two bubbles and the market believes that there are two bubbles and they meet and burst at the same time, investment grade credit spreads aren't going to be immune. I mean, they'll be safer than every other part of credit, but I'm kind of looking for places to hide at the minute, is how I describe things.
Yeah, to your point, I mean, I think there's a lot of concern around some of that investment grade credit that's priced not that much above treasuries, but you actually are being able to take on possibly some significant risks with the...
Well, 50% of the US hyperscaler AI capex is actually being financed in the US investment grade market.
That is Amy Xie Patrick, head of income strategies at Pendal Group, speaking with Bloomberg TV host Paul Allen and Annabelle Droulers here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. U.S. equities moved higher on Thursday, and information tech led the way. We had that strong outlook from industry giant Micron Technology, and that in turn boosted sentiment for all things related to artificial intelligence. Micron shares were up by more than 10%. Joining us now is Keith Buchanan. He is Senior Portfolio Manager at Globalt. Keith is on the line from Atlanta, Georgia. Keith, thank you for making time. How would you view the information tech group right now?
We still have exposure to Doug. We're looking at this market as really starting late in the fall as to when this handoff will happen, from really being able to bet on the direction of the Federal Reserve, direction of monetary policy globally, to really getting back to earnings visibility, business model certainty, balance sheet stability, those tried and true metrics that really drive markets in the interim after we get through this phase that we've kind of gone through the last couple of years. So Micron kind of shows that story is still alive, but we still believe in how the market has been trading since November, in that the market's really starting to appreciate and pivot towards names that throw off more cash, have more visibility as far as earnings, have more control over the outcomes of earnings over the next 12 to 24 months. And that's where we've been positioning our clients to benefit in 2026.
Does that necessarily mean small cap?
It doesn't necessarily mean small cap. We feel like the small cap move is just a move in rates coming lower. And that's probably going to be the case over the next, call it 5 to 6 months. But as we get into this, as a soft landing that we've been anticipating for, we as in the market has been anticipating for at least 2 years now, and kind of prematurely at times, now that it comes into focus, now that the outcomes of the Federal Reserve and the markets just in general becomes more widespread, and there are more mistakes that can happen from this point forward. And with that in mind, we're looking at the market and getting to those names that have a little more margin for error and aren't necessarily betting on one theme, one trade, one source of funding in order to generate cash flow and earnings that we feel like will drive the market further in 2026. So we're more diverse than we've been in some time. We still do have exposure to those names driving the AI trade, but not necessarily all of our bets on one trade.
So as a result of the last Fed meeting, we learned that policymakers in aggregate are expecting to make only one more rate cut in the new year. But the swaps market right now is still convinced that we've got 2 rate cuts from the Fed happening in 2026. Where are you right now in understanding what the Fed is going to be challenged with in the new year?
It's really interesting that you brought that up because you see the dispersion around that normal-ish distribution being wider than it's been in the past. The market just doesn't know. And the difference now is people that don't know and people that don't know they don't know. And coming into a new chairperson of the Federal Reserve, I think the market's priced in that there will be some leeway and perhaps even some consensus that can be built early and maybe get 1 or 2 cuts in the spring. But then there are lots of question marks about where inflation goes, where labor is, and the like, kind of coming through the second half of next year. We don't really veer away from that. That uncertainty is what kind of drives us to more rational cash generation as far as how we position our clients. And we feel like that trade can take hold early in 2026 in a way that it started to in the last part of this year. So we know that we don't know. And we embrace that as part of our thesis that there are a lot of moving parts from a monetary policy standpoint, and being with companies that have balance sheet stability and don't have to really rely on the capital markets as much and aren't as reliant on lower rates going forward is a place we want to be with our clients' assets.
Where does that leave you with regard to the bond market?
Sure. We're looking at the long end as somewhat stubbornly high coming into 2026. The short end and a steepening is kind of in our base case for what we expect going forward. We don't think that the Fed will really dive into 4 or 5 or 6 cuts into the latter part of next year. We don't feel like that's necessarily anything we want to bet on at this point. But we do think that inflation being stickier, perhaps even real growth being stickier than the market really expects at this point, can have the long end higher with the short end, maybe perhaps a tad below where we are now, but a steepening effect away from what consensus thinks is kind of where we see things playing out in 2026.
So we remember well the month of November and a lot of the questions around artificial intelligence, the whole AI trade. There was a lot of volatility in the market, and then when the dust settled, the move was higher. And we're very near records right now if you look at the major benchmarks in the U.S. Are you surprised that we haven't seen a meaningful pullback?
Not necessarily. Look, the earnings picture is clear. There's a significant, the disproportionate level of cash flow and earnings that those names present to the marketplace deserves a reward, and the market's rewarded. And that I don't know if I even call it a dislocation, but the difference between those valuations and the rest of the market have been warranted again because of the way they've been able to execute. So that pullback necessarily hasn't been anything that we're totally banking on. Again, we're market weight a lot of those names that you mentioned, market weight the theme more specifically. But we want to make sure we're diverse and have bets spread across sectors and names that present that case I presented a few minutes ago of balance sheet stability, earnings visibility. And that's where we want to make sure we have exposure and we're not underweight those spaces because we see the viable case for investing for 2026 returns in those names as well.
Keith, we'll leave it there. It's always a pleasure. Thanks very much. Keith Buchanan, Senior Portfolio Manager at Globalt, joining from Atlanta, Georgia, here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.